Your 401k balance, your job, your mortgage payment, and the savings sitting in your bank account, a recession touches all four at the same time, and most people find out how after it's already started. Right now, Wall Street is having a quiet argument about whether 2026 is the year that finally happens. Some forecasters say no, others are not so sure. The New York Fed's recession model currently puts the odds at around 17%. Moody's had them as high as 49% earlier this year. The Conference Board is projecting GDP growth of just 1.8%, the kind of number that doesn't feel like a recession until something else goes wrong. This video isn't a prediction, it's a map. By the end of it, you'll know exactly what a recession does to each corner of your financial life, not in theory, but in dollars, so that whatever happens, you are not surprised. There is one thing you need to understand before everything else in this video. A recession is not a single event, it is a sequence. GDP growth slows or turns negative. Business revenues fall. Companies cut costs. Layoffs begin. Consumer spending drops because people either lose income or fear losing it. That drop causes revenues to fall further, which triggers more layoffs. The loop feeds itself. Since 1950, the US has experienced 10 official recessions. 7 came with meaningful stock market declines. 3 did not. You cannot know in advance which kind you're in until you are already through it. What you can know is what the damage typically looks like, and what the 2026 setup means for your money specifically. Start with jobs, because that is where most people feel it first. In a typical recession, unemployment rises by 2 to 4 percentage points. That sounds small. A 2-point rise from today's 4.5% unemployment rate brings it to 6.5%. That represents roughly 3 million additional people out of work. The 1981 recession pushed unemployment to almost 11%. The COVID recession briefly hit nearly 15% before snapping back. The more important number is not the one that makes headlines. It's the average time between job loss and the next job. In a healthy economy, that gap runs about 9 weeks. During the Great Recession, it stretched past 40 weeks. That is 10 months of income gone, 10 months of dipping into savings, rolling over debt, missing retirement contributions. Meet Daniel. He is 38, earns $85,000 a year, and has $28,000 in an emergency fund. His monthly take-home is about $5,300. His fixed expenses run $4,100 a month. He has a cushion, but if a recession hits and he loses his job, his $28,000 is gone in 6.6 months. If job searches stretch past, as they routinely do in deep contractions, Daniel starts choosing between his mortgage and his credit card. Economists at the Brookings Institution have documented that even workers who keep their jobs spend less during recessions because they fear they might not. That behavioral shift, millions of Daniels pulling back simultaneously, is part of what makes recessions self-reinforcing. Now look at the stock market, because that is where retirement savings live. In the 7 recessions since 1950 that came with market declines, the S&P 500 dropped an average of 31%. The range ran from 18% to 55%, with the worst loss coming in the 2007 to 2009 Great Recession. Since 1970, the average peak to trough drawdown across all recessions has been about 36%. Daniel has $120,000 in his 401k. A 31% decline takes his balance to $82,800. A 36% drop brings it to $76,800. He has not sold a single share. The market moved and $43,000 disappeared on paper. 2 things make this worse than it sounds. First, markets fall before a recession officially begins. The S&P 500 peaks on average 5 months before the NBER formally declares one. By the time most investors recognize what's happening, the sharpest part of the drop is already behind them. Second, the worst decisions happen immediately after. Panic selling into the decline, locking in losses right before the recovery. The S&P recovers an average of 40% in the 18 months following a recession's end. The investors who captured that recovery were the ones who stayed invested through the pain. The sectors hit hardest are consumer discretionary, travel, retail, entertainment, automotive. The ones that hold up best are healthcare, utilities, and consumer staples. People stop buying new cars before they stop buying groceries. The housing market is where a recession gets counterintuitive. The common assumption is that prices fall. Sometimes they do. The Great Recession saw values drop roughly 33% from peak, but the 2020 recession lasted just 2 months and was followed by one of the most aggressive housing price surges in US history. Context matters more than the label. What is more consistent is mortgage rates. In a recession, the Federal Reserve cuts interest rates, which pulls down Treasury yields, which pulls down mortgage rates. If a 2026 recession pushes the 10-year Treasury from 4.5% down to 3.5%, mortgage rates could fall from today's 6.5 to around 5.5%. On a $400,000 30-year loan, 6.52% versus 5.5% is $247 a month. Over the life of the loan, that is $88,920. If you have a stable job and are a buyer, falling mortgage rates can hand you a six-figure discount on the same house. The people who lose in a housing recession bought at the peak with thin margins and then faced job loss. The 2026 setup is not 2008. There is no subprime mortgage crisis underneath it. Now, for the piece most people ignore entirely, what happens to the cash in your bank account? The FDIC insures deposits up to $250,000 per institution. That protection does not waver in a recession. Your checking account is not going down 31%. That part is safe. What changes is the interest that account earns, and it changes in the wrong direction. When the Federal Reserve cuts rates to fight a recession, banks lower what they pay on deposits almost immediately. High-yield savings accounts currently paying around 4.2% could fall to 3.2% or below. The average big bank savings account, already paying just 0.38%, drops further toward zero. Here's what that means for Daniel. His $28,000 emergency fund at 0.38% earns him $106 a year. The same money in 3-month Treasury bills at today's 3.71% yield earns $1,039. Even if a recession drives those yields down to 2.5%, he still collects $700, more than 6 times the savings account rate. The rate compression that hits deposits in a recession is predictable and knowable in advance. The people who benefit least are the ones who never moved their cash out of a big bank in the first place. So what do you actually do? The honest answer depends almost entirely on 2 things: how stable your income is and how much liquid savings you hold. If your job is reasonably secure and you have 3 to 6 months of expenses accessible, the data is on your side. Stay invested. Markets recover every single time. The worst outcomes in every recession belong to people who made fear-driven decisions at the bottom, selling in March 2009, pulling out in April 2020, right before both moments became 2 of the best buying opportunities in a generation. If your income is fragile and your savings are thin, the priority is not your 401k, the priority is liquidity. Cash that is not tied up in markets cannot be forced out at the worst possible time. If you own bonds in a retirement fund, find the duration on the fund's fact sheet. That number tells you how much your fund moves for every 1 percentage point change in rates. A duration of 6 means a 1-point Fed cut adds roughly 6% to your fund. A duration above 15 means it swings like a volatile stock. Knowing your duration is not optional. It is the difference between understanding what you own and guessing. If you have been sitting on a large savings balance at a major bank earning 0.38%, a recession-driven rate cut makes that gap only worse. Treasuries and high-yield savings at competitive institutions are paying multiples more right now with identical safety. The time to close that gap is before rates fall, not after. Here is what most financial content skips. Recessions are not anomalies. They are built into the system. Since 1950, the US has had 10 of them. There has never been one that did not end, and there has never been a prolonged expansion that did not eventually slow. The 2026 risk is real but not certain. The SOM rule, a reliable recession signal, sits at just 0.10 right now, well below its 0.50 trigger threshold. GDP is still growing, but the economy is moving at 2 speeds. Upper income households and AI-driven business investment holding the headline up, while the average person is increasingly stretched. Whether top-heavy spending can continue to carry the broader economy is the open question for the rest of this year. Asking whether a recession is coming is the wrong question. The right question is whether your financial life can absorb one if it arrives. The people who get hurt most in recessions are almost never the ones who predicted them wrong. They are the ones with no cash buffer when income stopped, no plan for their bond exposure when rates moved, no understanding of what their 401k would do when markets sold off. They were not unlucky. They were unprepared. By the time this video ends, you are not in that group anymore. Hit the like button if this gave you something concrete, and I'll see you in the next one.